You ever glance at a financial chart and it just looks like a total mess? Just a bunch of chaotic, jagged lines. It can feel like pure noise. But for traders, those lines tell a story. It's a story about a battle between buyers and sellers, a story of opportunity, and yeah, a story of risk. Today, we're going to learn how to read that story.
So here's our game plan. We're going to start with the absolute basics of reading charts, then we'll get into how to spot a key trading signal called a breakout. After that, we'll take everything we've learned and apply it to a real-world fight, MicroStrategy. We'll look at why people are bullish, why people are bearish, and wrap it all up with a classic dilemma every single trader faces.
All right, first things first. We have to learn the language. It's just like reading a book, right? Before you can get the story, you've got to know what the words mean. Well, in trading, those words are patterns and trends.
Yeah, I know. A chart like this can look seriously intimidating, right? But believe it or not, there are simple, repeatable patterns hidden inside all of that chaos, and we're going to break them down right now.
So, the tool that traders use is called technical analysis, and you can think of it like learning to read the market's body language. It's not really about a company's earnings reports or their products. It's all about patterns, human psychology, and the momentum that you can see right in the price itself. And the most crucial point is this: it helps traders decide when to make their move.
The most basic pattern of all is the trend. An uptrend is just a series of peaks and valleys that keep getting higher and higher. A downtrend, you guessed it, it's the exact opposite, a series of lower peaks and lower valleys. It sounds super simple, and it is, but this is the foundation for pretty much everything else.
Okay, but what about when the price stops moving in a trend? We call those levels support and resistance. And I love the swimming pool analogy. Resistance is the ceiling. It's a price the stock just struggles to break above. Support is the floor, a price that has a hard time falling below. And you better believe traders watch these levels very, very closely.
So we know about floors and ceilings. Now let's turn that theory into an actual playbook. Let's see how traders use that knowledge to make a real move in the market.
This is the key question, isn't it? I mean, knowing there's a ceiling and a floor is one thing, but how do you actually profit from that information? Well, the answer often comes down to waiting for the price to smash right through one of them.
This is a classic four-step playbook called the intraday breakout. First, you pinpoint the floor and ceiling for the day. Second, you just sit back and wait for the price to break through one of them. Third, and this part is absolutely crucial, you look for confirmation so you don't get faked out. And finally, you make your move, but only after you've set up your safety net.
Let's walk through it. Here in step 1, you can see the trader has just drawn a simple line at the highest price from the day before. That price is now the ceiling. That's the resistance level that they are going to be watching like a hawk.
Now for the confirmation step. The price pushes through that ceiling, but a smart trader waits for more evidence. Look at the chart. See that huge spike in trading volume down at the bottom? That tells you a ton of money is suddenly rushing in. They also see a bullish signal from another tool, the RSI, which measures momentum. Both of those signals together tell the trader, hey, this is probably a real move, not a fake out.
And finally, we have the execution. The trader buys, but look closely. The first thing they do is place a stop-loss order just below a recent low point. That's their safety net. It automatically defines their maximum risk on the trade. Honestly, this kind of discipline is what separates the pros from the amateurs.
Okay, now that we've got the playbook, let's see how it applies in the real world, where billions of dollars are on the line. Our battleground today is the stock of a company called MicroStrategy, ticker MSTR.
So, who is MicroStrategy? Well, they started out as a pretty standard software company. But a few years ago, they made a radical, and I mean radical, pivot. They started using their cash and raising debt to buy Bitcoin, a lot of Bitcoin. And what that means is that their stock is now seen by a ton of people as basically a substitute for owning the crypto itself.
This wild strategy has created a huge debate with two very, very different sides. So first, let's hear from the bulls, the ones who believe this stock is headed for the moon. And for them, the argument is surprisingly simple.
This quote from a user on Wall Street Bets just perfectly captures the entire bull thesis. They look at this company and see that its main asset, all that Bitcoin, is actually worth more than the company's entire stock market valuation.
And the numbers here are just staggering. At the time of this analysis, the company was holding over 671,000 Bitcoins. This isn't just some side bet. This is the core of their entire corporate strategy.
And this brings us right to the bull's main point.
When you do the simple math, you just divide the value of all that Bitcoin by the number of shares, you get a value of about $187 per share. But at the time, the stock was trading down near $158. So for a bull, the conclusion is easy. The stock is on sale.
But of course, it is never that simple in the markets. Now we have to look at the other side of the trade, the bear case. They're looking at the exact same company and seeing a very, very different picture.
So the bears, they start with the chart itself. And what does it show? A crystal clear downtrend. The price is trading way below its key moving averages. You can think of these as lines that show the average price over different time periods. And when the price is below these lines, that's a classic sign of weakness. For the bears, the story on the chart matters more than the assets in the vault.
And if you want to know what the so-called smart money is doing, look at this. This chart shows where big institutions are placing their bets in the options market. And it's not even close. For every $1 betting the stock will go up, nearly $2 are betting it will fall. The big players are overwhelmingly bearish.
So here's the standoff. The bulls see a clever, discounted way to own Bitcoin. The bears fire back, pointing to billions in debt and the risk of share dilution. That's when the company issues more stock, which makes each existing share less valuable. It's a fundamental disagreement. Do you bet on the assets, or do you bet on the trend and the risk?
And this brings us to the final and really the most crucial question. What do you do when the fundamental story and the technical story are telling you two completely different things?
I mean, on one hand, you have simple math that says a stock is undervalued. On the other hand, you have a chart and the institutional money flows screaming that it's heading lower. This is the very heart of the trader's dilemma. So what do you think? In moments like this, is the market a puzzle that you solve with science, or is it a canvas that requires a little bit of art?